Stop scrolling. This is not just another price update. What just happened in gold and silver over the last few sessions is the kind of shift that changes positioning for months, not days. Today is Saturday, 21st February, and the charts are sending signals that most people will ignore until it is too late. Gold defended a level it absolutely could not afford to lose. Silver just detonated a compression pattern that had been building pressure for weeks. And when technical confirmation aligns with geopolitical escalation and a hawkish Federal Reserve, you are not looking at noise. You are looking at the early acceleration phase of a move that can catch people completely off guard. Let's begin with gold, because gold sets the foundation for everything else in the precious metals complex. Over the last stretch, gold experienced a sharp and uncomfortable pullback. It dropped hard from recent highs down toward 4,442. That move shook confidence. It forced out weak hands who chased momentum without understanding structure. But here's the detail that matters more than the drop itself. Gold did not break the trend. It did not collapse through critical support. Instead, it found buyers exactly where technical logic said they would be waiting. The 0.5 Fibonacci retracement level at $5,000 held, not approximately, not loosely, it held with precision. Price rebounded directly from that zone and is now trading just under $5,027 after reclaiming the psychological $5,000 level. That is not coincidence. Fibonacci retracements are mathematical reflections of market psychology. When a market retraces 50% of a prior advance and buyers step in aggressively, it signals that the underlying trend remains intact. Now combine that with the psychological magnetism of $5,000. Round numbers matter because institutions place orders around them. Retail traders anchor bias around them. When a 50% retracement aligns with a major round number, you get confluence, and confluence creates strength. Look at the structure now. Gold is being supported by the 50-period exponential moving average hovering around 490. That moving average is acting as dynamic support beneath price. Beneath that, the 200-period exponential moving average near 460 provides structural backing. On the 4-hour chart, higher lows are forming along a rising trend line. That is not weakness, that is trend preservation. Momentum confirms it. The relative strength index is sitting near 55. That is neutral to slightly bullish. It is not overheated, it is not stretched. In fact, it suggests there is room for expansion before we even approach overbought territory. In strong bull phases, RSI frequently lives between 50 and 75. We are far from exhaustion. Now focus on the next barrier. The 0.618 Fibonacci retracement level sits at $5,041. That is the next major hurdle. Historically, when price bounces cleanly from the 0.5 level and begins pushing toward the 0.618, it reflects strength, not fragility. Clearing $5,041 with conviction would open the door toward $5,033. And once price enters that territory, the probability of revisiting or exceeding prior highs increases significantly. Now shift your attention to silver, because silver is where momentum is accelerating faster than most people realize. For weeks, silver compressed inside a tightening triangle pattern. Price action narrowed, volatility contracted. Each rally attempt was capped at 78.44. Sellers defended that level repeatedly. Every time price approached it, supply overwhelmed demand, until it didn't. Silver broke through 78.44 decisively, not a weak poke above resistance, a surge. Strong bullish candles confirmed the breakout. Price pushed beyond $80 and held above the former ceiling. That transition from resistance to support is critical. When a level that capped rallies flips into a floor, it changes market psychology. Silver is now trading around 80.69. Immediate resistance is at 85.59, aligned with the 200-period exponential moving average. Above that, 92.14 becomes the next major structural target. From current levels near $80, a move to 85.59 represents roughly 6% upside. A move to 92.14 represents approximately 14% upside. In a confirmed breakout environment, those are not unrealistic projections. They are logical extensions. The RSI for silver sits near 60. That is firmly bullish without signaling overextension. In strong breakouts, RSI often pushes into the 70s before serious pullbacks occur. The 50-period exponential moving average near 79 now acts as support beneath price. Momentum, structure, and moving averages are aligned. Now step back and consider the macro environment, because this is where the story becomes even more compelling. The Federal Reserve has made it clear they are in no rush to cut interest rates. Minutes from the January meeting emphasized patience. Some officials even discussed the possibility of additional hikes if inflation remains stubborn. Employment data continues to show resilience. The US dollar has strengthened to multi-month highs. Normally, that environment pressures precious metals. A stronger dollar typically reduces gold and silver prices in nominal terms. Higher rates increase opportunity cost. But gold and silver are rallying anyway. That divergence matters. It tells you this move is not being driven by easy money expectations. It is being driven by risk. Geopolitical tension has escalated dramatically. President Trump issued a 10 to 15-day deadline to Iran regarding a nuclear agreement. That is not vague diplomacy. That is a defined time frame with implied consequences. Iran responded by warning that if attacked, they would retaliate, including potential strikes on key military targets. Consider the implications. The Strait of Hormuz handles approximately 21% of global oil supply. Any disruption there would impact energy markets instantly. Energy shocks ripple through inflation expectations. Inflation impacts currencies. Currencies impact global markets. Investors understand that chain reaction. This is why metals are rising despite a hawkish Fed and a strong dollar. The geopolitical risk premium is overpowering rate policy. Now here's the psychological part most investors ignore. By the time mainstream media fully embraces a move, the largest gains are often already behind it. Gold bottomed near $1,000 in December 2015. It climbed quietly for years. It broke $2,000 about 2 years ago with limited excitement. Only after crossing $4,000 last October did attention start building. Silver moved from the mid-teens to above $80. That represents more than a 400% advance. Early positioning captured the majority of that move. Late attention captures volatility. Markets move in stages, skepticism, awareness, euphoria. We are not in euphoria yet, but we are no longer in obscurity, and that distinction changes everything. Now let's go deeper, because what separates disciplined investors from emotional traders is not prediction, it is interpretation. Anyone can look at a chart and point to a green candle. Very few people understand what that candle represents within a broader structural cycle. And right now, gold and silver are not simply printing higher prices. They are transitioning from consolidation to expansion. That shift is where momentum begins compounding. Gold's defense of the $5,000 level was not just technical, it was psychological reinforcement. When a market revisits a major round number after a pullback and buyers step in decisively, confidence rebuilds. That reclaim above $5,000 sent a message. It told the market that the prior advance was not a fluke. It told institutions that underlying demand remains present. And when institutions step in, trends tend to persist. Look closely at the pattern forming on the 4-hour chart. Higher lows are gradually building upward pressure beneath resistance. That is classic bullish behavior. The 50-period exponential moving average near 490 continues to slope upward, reinforcing the intermediate trend. The 200-period exponential moving average near 4060 remains well below price, indicating long-term structure has not been compromised. Momentum is balanced. RSI near 55 suggests the market is neither exhausted nor overheated. The next decision point remains 5,000 from $41. That 0.6118 Fibonacci retracement often acts as a final barrier before a move extends toward previous highs. If gold clears that level with strong volume and sustained closes, the pathway toward 5.33 becomes increasingly probable. Markets do not move in straight lines, but they do respect structure, and structure right now remains intact. Silver's configuration carries even greater energy because breakouts from prolonged compression tend to generate acceleration. Weeks of coiling inside that triangle pattern built tension. Every time price approached 78.44, sellers absorbed demand. That repeated rejection created a visible ceiling. When price finally surged through and held above it, something changed. The market accepted higher pricing. Acceptance is key. A breakout without acceptance often fails quickly. But silver did not retreat back below 78.44. Instead, it established support above it and pushed toward 80.69. That confirmation increases probability of continuation. Immediate resistance at 85.59 now becomes the next objective. If price approaches that level with similar momentum, the 92.14 zone becomes a realistic extension. Momentum indicators reinforce the bullish case. RSI near 60 shows strength without extreme overbought conditions. In powerful trends, RSI can hover between 60 and 75 for extended periods. That suggests there is room for expansion before exhaustion becomes a concern. The 50-period exponential moving average near 79 acts as a floor beneath price, offering dynamic support. Now let's confront the macro contradiction again, because this is where many investors become confused. The Federal Reserve remains hawkish. January meeting minutes highlighted patience on rate cuts and even suggested additional tightening if inflation fails to cooperate. Strong employment numbers reinforce the idea that the economy can tolerate higher rates for longer. The US dollar has responded by strengthening. Under normal conditions, that environment suppresses gold and silver. Higher rates increase the opportunity cost of holding non-yielding assets. A stronger dollar reduces the nominal price of commodities, yet precious metals are climbing despite those headwinds. That divergence signals that another force is dominating the narrative. Geopolitical risk is the variable altering the equation. The 10 to 15-day deadline directed at Iran compresses uncertainty into a tangible time frame. Markets react more aggressively to deadlines than to vague rhetoric. Iran's response, indicating readiness to retaliate if attacked, adds a measurable escalation scenario. The Strait of Hormuz remains one of the most critical energy corridors in the world, responsible for roughly 21% of global oil transit. Even the possibility of disruption injects risk premium into markets. Risk premium drives capital into perceived safe havens. Gold historically serves as a hedge against geopolitical instability and currency uncertainty. Silver benefits both as a monetary metal and as an industrial component tied to global growth. When geopolitical tension intersects with structural demand and technical breakouts, momentum can accelerate quickly. Beyond immediate tensions, deeper structural forces continue building. Sovereign debt levels remain elevated. The United States alone faces interest expenses exceeding $1 trillion annually. As maturing low-rate debt rolls over into higher yield obligations, fiscal strain intensifies. Inflation historically becomes a politically tolerable method of reducing real debt burdens. Currency debasement erodes purchasing power over time. Precious metals historically act as insulation against that erosion. Industrial demand adds another layer of support for silver. Solar energy expansion, electric vehicle production, telecommunications infrastructure, medical technology, and electronics manufacturing all require silver inputs. Projected demand growth between 4 and 6% annually through 2030 creates a structural consumption floor. Unlike speculative demand, industrial consumption does not vanish overnight. Supply dynamics complicate the picture further. Mining output cannot be scaled rapidly. Developing new mines requires capital investment, regulatory approval, environmental review, infrastructure development, and years of preparation. Production inelasticity means supply responds slowly to price signals. During periods of rising demand, limited supply flexibility can amplify price movements. Understanding these structural components clarifies why current price action should not be dismissed as temporary volatility. However, it also reinforces the importance of discipline. Breakouts attract momentum traders. Momentum traders can create overextension if buying becomes emotionally driven rather than structurally grounded. If gold were to break decisively below the 4,090 region and lose the 50-period exponential moving average, short-term structure would weaken. If silver fell back under 78.44 and failed to reclaim it, the breakout thesis would need reassessment. These levels define risk boundaries, not predictions of failure. Recognizing boundaries prevents emotional overcommitment. Markets test conviction through volatility. Pullbacks will occur, headlines will shift sentiment rapidly. One day may show aggressive green candles, the next may deliver sharp red reversals. The difference between successful positioning and reactive trading lies in respecting structure over emotion. Right now, structure remains constructive. Gold defended $5,000. Silver flipped 78.44 into support. Momentum indicators remain healthy. Geopolitical catalysts are active. Structural demand forces persist. Debt and inflation pressures remain unresolved. The question is not whether volatility will appear. It will. The question is whether the broader structure remains intact during that volatility. As long as key support levels hold and higher lows continue forming, the path of least resistance favors continuation. This is the stage where awareness expands, but euphoria has not yet arrived, and understanding that distinction may determine how effectively you navigate what comes next. Now we need to talk about timing, because timing is where most investors either build wealth or destroy it. The numbers on the screen are important, the Fibonacci levels matter, the breakout zones matter, but none of that helps you if you do not understand what phase of the cycle you are operating in. Markets do not just move up and down, they move through psychological stages, and if you misread the stage, you mismanage your capital. Gold's defense of $5,000 was not just a technical event. It was a statement about demand. Buyers showed up at the 0.5 Fibonacci retracement exactly where structure said they should. Price dipped toward 4,442 during the broader pullback, but it did not collapse through major support. Instead, it reclaimed $5,000 and stabilized near $5,027. The 50-period exponential moving average near 4,090 continues to act as immediate support, while the 200-period exponential moving average near 4,060 sits below as structural reinforcement. RSI near 55 confirms that the move has room to extend without being overbought. The next obstacle remains $5,041 at the 0.618 Fibonacci retracement. If price clears that level with strength and sustained closes above it, the path toward 533 opens. That does not guarantee immediate acceleration, but it increases the probability of continuation. Markets respect structure, and structure right now remains supportive. Silver's situation is even more dynamic. The breakout above 78.44 was the release of weeks of compression inside a triangle pattern. That pattern built tension. Sellers defended 78.44 repeatedly. Once that level broke and price held above it, the psychology shifted. What was once resistance became support. Silver now trades around 80.69, targeting 85.59 as the next resistance aligned with the 200-period exponential moving average. Above that, 92.14 stands as the next significant extension. RSI near 60 reflects healthy bullish momentum without overextension. The 50-period exponential moving average near 79 offers dynamic support beneath price. This alignment of momentum, moving averages, and breakout structure suggests continuation as long as support remains intact. But here is where investors make mistakes. They see a breakout and assume it will move in a straight line. They see headlines about geopolitical escalation and assume price must immediately surge. They react emotionally rather than strategically. Markets rarely reward that approach. The Federal Reserve remains hawkish. January meeting minutes emphasized patience on rate cuts and left room for potential hikes if inflation stalls. Strong employment data has supported a stronger U.S. dollar. Under normal conditions, that would suppress metals. Yet gold and silver are rising anyway. That divergence signals that geopolitical and structural forces are exerting stronger influence than monetary policy alone. The 10 to 15-day deadline issued toward Iran compresses geopolitical risk into a defined time frame. Iran's warning that it would retaliate if attacked, including potential strikes on key military targets, increases perceived instability. The Strait of Hormuz, responsible for roughly 21% of global oil supply, remains a critical choke point. Any disruption would ripple through energy markets and inflation expectations instantly. Investors hedge against that uncertainty. Gold historically benefits during periods of geopolitical stress. Silver benefits both as a monetary metal and as an industrial component linked to global demand. This combination of technical breakout and geopolitical catalyst creates a scenario where price can accelerate despite a strong dollar. Beyond the immediate tension, structural forces continue building quietly. Sovereign debt remains elevated. The United States faces annual interest payments exceeding $1 trillion. As older low-rate debt refinances at higher yields, fiscal pressure intensifies. Inflation becomes a politically manageable path to reducing real debt burdens. Currency debasement historically supports tangible assets. Industrial demand strengthens silver's foundation. Solar expansion, electric vehicles, telecommunications infrastructure, medical technology, and electronics manufacturing consume substantial silver quantities. Projected demand growth between 4 and 6% annually through 2030 establishes a structural floor beneath price. That demand does not disappear simply because rate policy tightens temporarily. Supply remains constrained. Mining cannot scale instantly. New projects require years of development, capital allocation, permitting, and infrastructure construction. This supply inelasticity means that when demand increases, price often responds sharply, because output cannot immediately compensate. All of this creates a supportive backdrop. But cycles still matter. The early stage of a bull market is marked by skepticism. Few participants care. Accumulation occurs quietly. That stage occurred years ago when gold bottomed near $1,000 in December 2015. The middle stage is awareness. Narratives spread. Participation increases. Volatility rises. That is where we appear to be now. The final stage is euphoria. Media coverage becomes constant. Retail participation surges, price accelerates vertically. Euphoria is dangerous. Parabolic advances often end violently. Gold has experienced single-day declines exceeding 16% after blow-off tops. Silver has seen collapses greater than 40% within short time frames during prior cycles. Late entrants who buy at euphoric highs often panic during sharp reversals and exit at losses. We are not there yet. Mainstream coverage of precious metals remains moderate. Most financial advisors still prioritize index exposure over hard assets. Public participation is increasing, but it is not frenzied. That suggests middle stage awareness rather than terminal mania. Understanding this distinction changes strategy. Accumulation during structured pullbacks remains logical as long as support holds. Chasing vertical spikes without risk management invites volatility shock. Respecting key levels protects capital. If gold decisively loses 490 and breaks below the 50-period exponential moving average with momentum, structure weakens and reassessment becomes necessary. If silver falls below 78.44 and fails to reclaim it, the breakout thesis requires review. These are risk boundaries, not predictions. Right now, the evidence favors continuation. Gold defended $5,000. Silver flipped 78.44 into support. Momentum remains constructive. Geopolitical catalysts are active. Structural debt, inflation, industrial demand, and supply constraints remain unresolved. The opportunity lies in preparation, not reaction. Understand the stage, respect the structure, manage risk deliberately. Markets reward those who act with discipline rather than emotion. The breakout is confirmed. The targets remain visible. The macro backdrop is supportive. The cycle is still unfolding. What determines outcome now is not whether volatility appears, but whether you respond to it with clarity instead of fear. And clarity begins with recognizing where we are right now.